Today, we're tackling a big question many new investors ask: mutual funds versus ETFs versus hedge funds. Which one is actually better for beginners? If you've ever been confused about these three investment vehicles, don't worry, you're not alone. By the end of this video, you'll understand how they work, their pros and cons, and most importantly, which one makes the most sense for you as a beginner. Stay tuned, because the difference could literally save or cost you thousands of dollars. What are they? Let's start with the basics. Mutual funds. Think of mutual funds as a big pot of money. Investors pool their money together, and a professional manager invests it into stocks, bonds, or other securities. You buy shares of the mutual fund, and the value of your shares rises or falls depending on the performance of the fund's holdings. They're usually actively managed, meaning professionals are constantly trying to pick winners. They've been around for decades and are extremely popular in retirement accounts. ETFs, exchange-traded funds. ETFs are very similar to mutual funds in that they also pool money into a diversified portfolio. But the key difference, ETFs trade on the stock exchange, just like individual stocks. You can buy or sell an ETF at any time during the trading day. Many ETFs are passively managed, simply tracking an index like the S&P 500. They usually come with lower fees than mutual funds. Hedge funds. Hedge funds are the mysterious, exclusive club of investing. They also pool money, but unlike mutual funds and ETFs, hedge funds have fewer rules and can invest in just about anything: stocks, derivatives, currencies, real estate, even exotic strategies like short selling and leverage. They aim for high returns but often come with high risk. Most hedge funds require investors to be wealthy, what's called accredited investors, and the minimum investment can be in the hundreds of thousands or even millions. So in summary, mutual funds, professionally managed, widely available. ETFs, are stock-like funds, low cost, easy to trade. Hedge funds, high risk, high return, mostly for the wealthy. Fees and costs. Now let's talk money, fees and costs. Mutual funds often come with expense ratios of 0.5% to 2% annually. On top of that, some charge sales fees known as loads just to buy or sell. Imagine paying 5% just for the privilege of investing. That's money straight out of your pocket. ETFs are generally cheaper. Many index ETFs charge as little as 0.03% annually. That's just 3 per $10,000 invested. They also don't usually have sales loads. Hedge funds are in a league of their own. The classic fee structure is called 2 and 20, a 2% management fee plus 20% of any profits the fund makes. For beginners, these costs are astronomical. Bottom line, if you're new to investing, ETFs usually give you the most cost-efficient exposure. Liquidity and flexibility. Let's look at liquidity, how easily you can get your money back. Mutual funds. You can only buy or sell at the end of the trading day when the fund calculates its net asset value. No intraday trading. ETFs. Extremely flexible. Since they trade like stocks, you can buy and sell anytime the market is open. Perfect if you want flexibility or think you might need quick access to your money. Hedge funds. The opposite of flexible. Many have lockup periods, meaning you can't touch your money for a year or more. Even when you can withdraw, it may take months before you get your cash. So in terms of accessibility, ETFs win by a mile. Risk and transparency. Next up, risk and transparency. Mutual funds. Generally considered lower risk because they're regulated and diversified. You also get regular updates on what the fund is holding. ETFs. Same story. Regulated, transparent, and usually tied to an index. You can see their holdings updated daily. Hedge funds. This is where things get dicey. Hedge funds can use leverage, borrowing money to invest more, which magnifies both gains and losses. Their strategies are often secretive, so you may not even know what your money is invested in until much later. For beginners, too much complexity and lack of transparency are red flags. Minimum investments and accessibility. Let's talk about accessibility. Mutual funds. Some have minimums, often ranging from $500 to $3,000. Not too bad. ETFs. No real minimum beyond the cost of one share. These days, with fractional shares, you can even start with as little as $10. Hedge funds. Minimums can be $100,000, $500,000, or even $1 million. Not exactly beginner-friendly. So if you're just starting out, ETFs are the most accessible, with mutual funds as a close second. Which one is better for beginners? So, the big question. Which one is better for beginners? Hedge funds? Definitely not. Too risky, too expensive, and mostly inaccessible. Cross them off the list. Mutual funds? A decent choice if you want professional management and you're investing through retirement accounts, but watch out for high fees. ETFs? For most beginners, ETFs are the sweet spot. Low cost, diversified, flexible, and accessible. If you're new, starting with broad, low-fee index ETFs, like ones tracking the S&P 500, is often the smartest move. Practical example. Let's make this real with a quick example. Imagine you invest $10,000 for 20 years with 3 different funds. Mutual fund charging 1% fees, earning an average of 7% annually. ETF charging 0.05% fees, earning the same 7%. Hedge fund charging 2 and 20, but let's say it earns 9%. After 20 years, the mutual fund grows to around $38,000. The ETF grows to about $38,900, almost $1,000 more just from lower fees. The hedge fund, even with higher returns, might give you less than $35,000 after fees and profit sharing. This shows how costs and accessibility matter more than flashy promises. So, let's wrap this up. Mutual funds. Okay for beginners, but fees can eat into your returns. ETFs. The best choice for most beginners. Low cost, transparent, flexible. Hedge funds. Off the table unless you're ultra wealthy and willing to take big risks. If you're just starting out, keep it simple. Begin with ETFs that track major indexes, set up automatic contributions, and focus on the long term. Remember, it's not about chasing the most complex or exclusive investment. It's about consistency, discipline, and letting time and compounding work their magic. If you found this breakdown helpful, make sure to like this video, subscribe to the channel, and share it with a friend who's thinking of investing. Thanks for watching, and I'll see you in the next one.